The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Thank you for joining us for our quarterly webcast. My name is Erin Megan, and I am our Director of Wealth Relations. Today, our presenters will be our Managing Partner, Jim Neal, and our Chief Investment Officer, Jack Brown. They will be discussing our current and long-term outlook on the equity and fixed income markets. At the end of the presentation, I will open up the line for questions. You should see on your screen a dialog box in which you can type a question to me. Feel free to ask questions as they come to you, and they will be answered at the end of the presentation. Now, to start our presentation, I'd like to welcome to the call Jack Brown.
Thank you, Erin, and thank you, everyone, for joining us today. I have a few fairly brief comments on the market and the economy, which is, of course, intricately linked to how the markets do. So without further ado, why don't we jump to the first slide. This slide is entitled High Consumer Confidence, and confidence is kind of a big issue right now. If you think about the past 8 years, we've had this almost frustratingly slow, but it's been a slow and steady rate of growth in the economy. And that has led to, according to consumer confidence surveys, a high level of confidence. We see this in this and the other big survey that measures consumer confidence. So we are basically at levels consistent with good economic growth and a healthy economy. So with that, let's go to the next slide. So not only does confidence show up in just, yes, consumer answering a question, I'm reasonably comfortable with what I see in the economy, but we're also seeing it in terms of stock prices and bond prices and basically financial asset prices. In this slide here we have, it's titled Stocks Are Expensive, and the way we're measuring stocks with this particular slide is basically a PE ratio, which is today's price relative to recent earnings. In this particular chart, it's created by Robert Shiller, who won a Nobel Prize for basically understanding investors. And he came up with this approach, which is the average 10 years worth of earnings to kind of smooth out that earnings volatility. But needless to say, we're looking at current market prices relative to these smoothed out earnings. It gives us a pretty good objective way of looking at stock market valuations. What it's telling us today is that stock market valuations are about as high as they've ever been, and in fact, only twice have we seen valuations higher. That was the internet bubble that most of us remember from the late 90s, and something that probably none of us were able to experience, but back in 1929, and of course that was kind of not a good starting point for investors. But nevertheless, stocks are reasonably expensive now, and so of course we want to get a good sense of the future and risks and that sort of thing. The other place we see richer valuations, and that's on the next slide, is corporate bonds. Basically, a corporate bond, it's in the same sort of broad category as stocks in the sense that we're looking at investing in businesses. And if you were invest in company corporate type bonds, the yields are reasonably low right now relative to treasury bonds. And so let's think about that for a minute. If you were to go out there and buy a corporate bond, you would probably have a sense that the chance of default, whether it's small or not, is going to be higher than a treasury bond, because a treasury bond's backed by full faith and credit of the government. So nevertheless, that difference between corporate bonds and treasury bonds is called the spread. And this chart is showing us the spread of those two markets. It changes over time. As you'll see, this chart really sort of has a major spike in 2008. Of course, a lot of people thought corporate bonds were going to be a tremendous amount of defaults, and so yields went way up and bond prices went way down. So we see this big spike there. Most recently, we see a spike at the end of, actually at the beginning of 2016, and since then corporate bonds have been rallying rather strongly. And here we are today with yields that are pretty close to Treasury bonds, at least relative to history. So we're looking at a lot of confidence, going back to the confidence issue, confidence in corporate bonds as well as stock prices. So the next slide, please. This is a stock market chart. So bringing it back to risk, we want to understand, given that market valuations are pretty high, we really want to understand the risks that we're looking at. And this simple plain old stock market chart is showing us that major corrections, and these are corrections where the stock market, instead of taking 1 or 2 months to recover, maybe it takes a year or so, but those happen in and around recessions. So the big risk that we're facing is, what are the chances of a recession? So that is, in my mind, given the valuations, the question of the day. And so we'll spend the next couple slides on the economy. Next slide, please. One kind of broad way of looking at how the economy is going to fare in the next several months is something that we call leading indicators, and economists like leading indicators because it's looking at a variety of statistics that tend to give you a clue of whether the economy is going to turn up or turn down. And so this particular leading indicator index is a good one. We like it, and it's because it's fairly predictive. It's telling us now that there's really not much of concern in terms of the future growth of the economy. It's a favorable result, more or less. And the next slide, please. Okay, so the consumer debt and debt overall is an important issue because one thing happens when we have this borrowing and lending cycle. It's very systematic in studying the borrowing and lending cycles, because what happens is when credit expands or people or businesses are borrowing money, there's a growth rate in the level of debt. This is particularly here we're looking at consumer debt. Now the growth rate of consumer debt is low. It was really low a couple of years ago following 2008. In fact, it was negative. And now it's started to resume its climb upwards. But today, even still, the growth rate is very low. What this tells me, or at least the way we're interpreting it, is that we're kind of still in the early innings of the borrowing and lending cycle. In other words, the borrowing and lending cycle could ramp up quite a bit more, and of course, the economy almost like clockwork expands as the lending cycle picks up. So that's important to understand. And one other concept we want to understand is there capacity? Can consumers borrow money in a reasonably safe way? So on the next slide, we see basically the levels of consumer debt. Here we're looking at household balance sheets, and we're looking at household liabilities or debt relative to the net worth. And on that measure and a lot of other similar measures, what this is showing us is that the level of household debt is reasonably low. In fact, it's not a bad starting point for consumers were they to decide to start borrowing money at a somewhat of a faster clip. So we're kind of at a healthy level. The households are at a healthy level overall. We got a lot of room to pick up the pace in terms of things like borrowing and lending. So that's, I think, overall a pretty good snapshot there. Next slide, please. Another thing we like to see, and it's always one of the first things out of most economists' mouths when they talk about the economy, is what about employment? A ton of different ways to calculate, look at it, measure it. This is one of several. I think it's fairly interesting, though. This is the total workforce as a percentage of the working age population. So you might hear it called participation and that sort of thing. Far right part of this chart is showing us the current level of workforce participation. And if you kind of just look at it, you'll see that we're in a pretty healthy level. In other words, a lot of people are working, and we certainly could go higher than this. So there's a decent amount of workforce participation, which typically means that we're in a healthy environment that could lead to things like pay increases and more money floating into paychecks, which ultimately finds its way into the economy, and that's obviously good in terms of considering future economic growth. Next slide, please. So the last chart that I'll bore all of you with is called "The Business Lending Has Slowed." And this is so we're looking at the whole picture. We want to get a sense of everything. We just don't want to look at the positive things. So this really is the only thing that sort of stood out to me as, okay, this is something we want to kind of keep an eye on. Here we're looking at things like commercial and industrial loans, and that particular is the red line. And what you'll see, that's the growth rate over time, and similar to the borrowing and lending cycle in consumers, we're looking at businesses. When it slows down, sometimes it's one of those things you kind of have to keep an eye on. It could be a concern. In this particular case, we're not overly concerned because what we are seeing on the other side of this is that while business lending may have slowed, it's probably for fairly simple reasons. And in fact, when you look at things like investment, we're seeing businesses and a lot of private investing starting to take place. So we're not really overly concerned about this, but certainly it bears something to keep an eye on. So with that, we'll sum it up on the next slide. Basically, the theme from our perspective, a lot of confidence out there that has ultimately led to expensive or rich market type valuations. And so we want to get a good sense of, are things too expensive? We certainly don't want to be in a bubble, but let's study that. And there's enough caution out there to really give us some comfort with what we're seeing in the market valuations. Nevertheless, the primary risk would be recessions. So when we zero in on the economy and look at the likelihood of future economic growth, things look pretty good. Leading indicators are fine. There's plenty of people working and more people going to work. Consumer debt is low and it's growing at a slow pace, and there's a lot of confidence out there. Businesses overall, while we do see a bit of a slowdown in lending growth, profit margins are very healthy. There's a lot of cash flowing through businesses, and that's obviously a good sign. So we're obviously keeping a close eye on the warning signs, and on that front, things look pretty good. So that's where we are, and with that, I'll turn it back to Erin.
Thank you, Jack. With that said, thank you for reviewing the equity markets for us. Jim, did you want to take over on the fixed income and oil?
Certainly be happy to. I want to thank all of you for joining us today. I'm going to start off by reviewing interest rates, oil, and then the continuing impact of the Trump election. If you recall, these are the three subjects I talked about at the end of January when we reviewed the year, and I just want to give us an update of where we are on this. You will go to the next slide and look at interest rates, and this is the history of the 10-year Treasury. Jack talked about corporate some. This is the history of the 10-year Treasury going back to 1960. And it continues to look in a downturn. We were at a little higher at a couple of months ago. We're at 228 when we prepared this last week. It's about 230 today. That, if you look at it from where it's come from the early 1980s on down, it would appear to be going lower. We just don't believe it will. And as you go to the next slide, last time we talked, we said we thought they would go higher. I guess I should have indicated in capital letters we were wrong. If you recall, we talked about what goes into the yield on the 10-year Treasury, and it typically is the anticipated rate of inflation. In other words, if you're an investor considering buying the 10-year, you would expect to get the rate of inflation so that at the end of 10 years, your purchasing power would be equal to what it was when you purchased the 10-year Treasury. In addition, we commented that you should expect something in addition to the rate of inflation for letting the government use your money. We went through an analysis and concluded that perhaps you should get 1 to 2%, which suggested to us that the yield could go considerably higher over the next year. Well, we were wrong. But I would say that as we look at it, they will go higher during someone's lifetime. If I take everyone who's on this call today, I'm willing to bet that they will be higher during someone's lifetime. We would say that we believe the 10 years should go to 250 to 3%, could or should go. by the end of this year. It's not a leap to get from 230 to 250 to 3%. If the economy does strengthen from here, good economic activity should drive the inflation rate modestly higher and the expectation of additional inflation higher, which would lead to, we would believe, higher bond yields. If you go to the next slide, we'll look where they actually are right now. This is the 2-year, 5-year, 10-year, and 30-year from different periods, and I would direct you to the bottom 3 lines. At the 30-year was 3.06. At the end of the year, it was 3.06 at the end of January, and now it's 2.97. That's not a big move, but when you look at the 10-year, the 10-year has gone from 215 to 249 and now back down to 232. So we've seen a little bit of a round trip there. The 5-year, 193, 194 down to 184. And the 2-year, which is heavily influenced by the federal funds rate, has gone from 120 to 128. So we're looking at a continuing low yield curve that has flattened somewhat. We don't believe that that pattern will continue, but there are, for the reasons of economic growth and factors like that. But if we go to the next page, we have to recognize that in most of the developed countries in the Western world, interest rates are actually lower than we are here. I think you've all seen this chart before. The numbers change, and they continue to show that if you invest in the Switzerland market, the 2-year gives you a negative return of almost 1%. And if you go out and buy the 10-year Swiss bond, you're going to get a negative return of 0.19 per annum for holding that bond. And you have to go down to the United Kingdom on the 2-year to get a positive return. Italy, Spain, they have negative returns for 2 years. This is just unbelievable. If you look at it, you would take a course in psychology probably to understand why investors would invest in countries like this. The expectation of perhaps better growth in Europe should lead to higher rates. Now we will see what happens in the French election this weekend, whether the French exit happens, or whether the country votes to basically elect a president who will keep them in the EU. But rates should go higher there, but as long as we're competing against that, there's probably a cap on how high our rates will go. On the next slide, we look at oil. This is similar to the chart that we showed last time. It's been updated for a quarter, and it continues to show that the International Energy Agency, and we use their data, expects that demand will surpass supply this quarter or early into the third quarter, in which case they're showing from end of last year, they're showing a decrease in supply, which is consistent with the OPEC reductions that were brought about last fall. And they showed a decrease in demand, but beginning about now, we are looking for a pickup in demand, which would create an imbalance to the demand side, which would suggest better prices looking out. Within this, they are continuing to look, and we agree with it, that oil should hit into the high 50s, low 60s, perhaps mid-60s by the second half of this year. Now, there is an assumption in here, and it's here at the bottom, that the OPEC, non-OPEC output cuts are implemented as announced. And what that means is last fall, Saudi Arabia and the OPEC countries agreed to a fairly significant production cut in order to drive the price high. They were successful in that. However, the U.S. supply, driven by shale oil production, predominantly in Texas, has picked up. Nevertheless, the numbers stay here as is shown. The big question is, what does OPEC do at their next meeting, which is scheduled for the end of May? I believe it's May 25th. There is an assumption that OPEC will continue this production decrease, although there are some who would like to see it reversed. The Saudis are in a difficult position here. They are trying to bring the Saudi Arabian National Oil Company, Aramco, public. They are going to file for an initial public offering, and quite obviously, the higher the price of oil at the time they file will make the deal look better. We believe they are sane. We believe they will continue the production cuts and that Aramco, the IPO, will probably come sometime over the summer. Now, we are dealing with the Mideast, so sometimes what seems sane and logical doesn't occur, but it would be difficult in this case to believe that they would cancel their production cuts. Should they do so, then the outlook here will change. Can we go to the next slide, please? The impact of all of these discussions on our investment disciplines, and this is my last slide, so I'll try to make it as clear as possible, on our fixed income issues. And here we're talking in the enhanced income sector where we are predominantly using either closed-in fixed income funds or ETF. We think for the indefinite future they are likely to maintain their current income distributions. And assuming that if rates don't soar, NAV should stay flattish, again, for the indefinite future. The give and take of trading in the open market can push them up or down a little bit. But really, as we look at their net asset values going forward, we do not expect to see any particular major change until interest rates move. On the equity side, NAVs are quite a bit higher for the year, because the market has been strong, and some of the funds we're using have done quite well. But they will be affected if the market corrects. Go back to Jack's PE analysis and the discussion that a correction is possible. If we do get a correction, the net asset values and the market prices of the equity funds will correct. On our portfolios that are designed for appreciation, we have both a disciplined value and a disciplined growth portfolio. The disciplined value that Jack runs had an excellent year in 2016. It was up over 20% net of fees. It was a remarkable performance. The performance, while not running as high as the market right now, is continuing to go higher in 2017. And based on the portfolio itself, I think it will have an excellent year. Our growth portfolio had a difficult year in 2016, as many of the traditional growth stocks lagged, particularly in the biotech and healthcare area, and even some of the technology names had a difficult year. However, 2017 is quite an opposite story. We are seeing significant performance in many of the traditional names, and we're going to see quite a bit of activity, we think, tomorrow afternoon after the market closes. Both Apple and Facebook will report earnings. Google reported last week, which is a large holding for us in our growth portfolio, and it was up 4 to 5%. It has continued to show some strength since then. We're optimistic for both Apple and for Google, for Facebook, excuse me, and we'll know what their earnings are after the market closes tomorrow. We do expect to have a very good year in growth, but again, should we get a correction, there will be profit taking. We think that the year for both value and growth will be quite good. And that really brings me to the end of my prepared comments. Erin, I will give it back to you and see if there are questions.
Great. Thank you, Jim. We will now open the call to our question and answer session. We would like to keep the questions to general questions on the bond and equity markets, and ask that if you have any stock-specific questions, you contact us privately, and we will be happy to speak with you about them. Our first question looks like it's going to be for Jack. In your quarterly newsletter, you mentioned the risk of a recession in the next 1 to 5 years. What are you doing to prepare for this, and how do you think it will be compared to the financial crisis in 2008?
Well, at this point, all the lights are green right now. So it would be, a recession would be sort of normal to expect one every several years. We haven't had one for 8, so just by law of averages, we probably will have one sometime within the next 5 years. Basically, to prepare for recessions, first of all, it helps tremendously if you get a good sense that they're coming and the market has not yet reacted. And in that case, you certainly want to minimize exposure to certain stocks that might do particularly roughly in those periods, and so that can happen. I know Right now, there's a little elevated level of cash in the disciplined value strategy that I run, but it's not saying I think a recession's coming. It's kind of looking opportunistically for new investments. But so it's kind of a matter of preparing sort of at a point where you're a little more certain or have a little bit better of a sense that one may be coming. At this point, again, the lights are green, so there's nothing really to do right now.
Okay. Jim, this one is directed towards you. Do you think the tax return, or the tax reform, excuse me, presented will be passed, and how will it affect markets and your portfolios?
Well, a couple of parts of that question. The first part is, do I think it will be passed? In the version in which it was introduced to Congress, no, I don't think that the President's initial version will be passed. Remember, the the name of his book is the Art of the Deal. I think this was his opening bid, his opening position. It gives you a clue as to what he is really looking for. And I do think there will be a tax bill, but as it was presented, no, I think there will be quite a bit of changes. I do believe that the business tax area has a better chance of passing with lower corporate tax rate and some incentives to bring the foreign earnings, which are now in the trillions of dollars, back to the U.S. When you get to personal tax rate, I think Washington is so divided, Congress is divided. I think it is difficult with this division to get any meaningful reform, particularly if they're trying to eliminate the inheritance tax. Anytime you try to pass tax reform that lowers general brackets, there's always some concern that you're giving tax breaks to the wealthy. So I think it's less likely we'll get much in the way of personal tax relief, some, but not a lot. I think we'll get remarkable good tax relief in the corporate world. The impact on portfolios, I think, or in the markets will be favorable. I clearly believe that if the corporate tax rate is lowered from 35, I don't think it'll go to 15. But whatever it goes to, for the companies that are paying close to the full tax rate, that is money that will drop to the bottom line. So I think now, is it discounted in the marketplace? Clearly there is some discounting going on. When you get more details out and you get a sense of the likelihood of what will pass, you'll get a better feel in the market for how much of an impact it will have. But should it pass with good corporate tax relief, the market should do well.
Thank you. Next question is not directed towards anyone, so either of you can elect to answer it. The question is, it seems like the labor market is tightening. Is wage push inflation a threat?
Sure, I'll take it. Wage push inflation, a little bit of inflation probably would be welcome in the sense that that would essentially mean payrolls are going up. So from a consumer standpoint, I think that would be a positive, especially since we're still coming off kind of a slow level of wage growth. So I think initially it would be good. Certainly if we see too much of it, you start seeing a lot more general inflation. And in that case, of course, you know, the game changes a little bit because right now we're still coming off this period where interest rates are very low. There is a large supply of goods and globalization and you know, low overall rates that are kind of keeping a lid on inflation, at least for the developed world. So if that were to come to pass, a lot of things would change where wage push inflation becomes somewhat damaging to the overall markets.
I'll add a thought to that. If you look at the actual unemployment rate, it would suggest that wage push inflation could easily come. However, if you look at the number of people who are unemployed as a percent of the population, that number remains quite large, and it suggests that if there is a movement of people from that into the job market, that there may not be as much wage inflation as one would expect when you get the actual inflation rate below 5%.
Thank you. We have another question. With the conclusion of quarter end, what, in your opinion, is keeping interest rates so low?
Well, I think there's not a lot of inflation, as we've just discussed. B, as you look abroad and you look at foreign markets, there continues to be low levels there, which I think puts a cap on how high ours can go, as money will flow in here, keeping rates low. Jack pointed out that there's plenty of expansion ability in the economy. And I think that there just is, there's not the fear factor that would tend to drive interest rates higher. Jack, if you have anything, you can add it.
I think that was a great answer. One other area I believe is very interesting that we're keeping our eye on, that most people are pretty well aware of, is that massive Fed balance sheet. We see a lot of reserves overall at banks, and at some point that will shrink, and that basically means either the Fed will be selling securities, which would tend to increase their yields, or even if they kind of just roll off the balance sheet as they're talking about, that would lead banks to probably want to start lending more money. And either of those situations could at some point lead to increased rates. I don't see that being a big concern or the massive risk for rates going up, but I think it's one of the more interesting dynamics in the economy right now.
Thank you. Another question. Should the U.S. take military action against North Korea, what would the likely effect be on the U.S. stock market?
Well, I'll jump in on this one. I think if we take action against North Korea, there'll be one of two things will happen. The market will either decline sharply or the exchanges will be shut down until there's clarification as to what's the outcome likely to be. When I say outcome, I don't think there's any doubt that the U.S. can defeat North Korea. The problem is that Seoul lies within striking distance of the demilitarized zone in the beginning of North Korea, and they have a lot of artillery and missiles aimed at Seoul, which has 20 or 25 million people. So if Kim is as irrational as we believe he is, and a war breaks out, he may launch not nuclear weapons, but clearly destructive weapons towards the South Korean population. And in that case, I think we'd see a market that would sell off pretty sharply.
Okay. Another question. What was the main driver behind the poor Q1 GDP number?
Well, if you just look at the breakout of GDP, consumer spending was where it lagged, and it didn't quite meet what most economists thought it would do. But on the other hand, there's almost no economist that's really wringing their hands over it. And the main explanation is that the first quarter, every first quarter we've had since the recession has been soft. And what some people are saying is that there's this seasonality effect. All this money gets spent in December, and then the new year rolls around, and for some reason the smart minds at the government haven't really figured out the best way to adjust for seasonality. At least that's what people are saying. On the other hand, it's certainly something to keep an eye on. It goes against pretty much a soft GDP number goes against our thinking from a longer term standpoint. So, but it's obviously something that's important, and we want to keep an eye on it.
Great. Looks like we've come to the end of our question and answer session. We want to thank you for joining us today. Should you wish to revisit our broadcast, you will find a replay link on our website in approximately 24 hours. As always, we welcome your calls, and we are always here to help you should you need anything. Thank you for doing business with us, and thank you for joining us today.